Here we're going to dive into Booking.com. But before we look at the chart and all of the characteristics that really underlie all of the great shaper patterns that we're going to look at later, I want to reinforce the idea that it's really the fundamentals that drive this stock move. And you're going to see Booking.com was a real super winner. But really, Booking.com was changing the way we work, live, or play. It was changing the way we travel. And I mean, I know from experience, when I was a kid and we would drive down to Florida from Montreal every year, we would have to stop off and look for vacancy at hotels along the way. Now, the ability to go online and book a hotel and check for reviews and get an idea of prices is just a much better way to travel. But that wasn't available back in the 90s. So this stock and what propelled it was really the fact that they were changing the world around them. Now you want to look for those institutional footprints on these shaper patterns, and that's what we're going to look at. But you always want to keep in mind that it's the fundamental story and what this company is doing that really drives and sustains these major moves. So here we're going to look at the weekly chart of Booking.com. It's really essential that you study these weekly charts. They provide the perspective and they eliminate all the noise of shorter-term market movements. And really there's also data and viewpoints that come up on the weekly chart that you just won't notice in the noise of the daily charts. Most people who are struggling to find and buy winners are often overlooking all these basic criteria that underlie these bases, and they're really looking for just any kind of consolidation in the marketplace, but the quality bases that form need to have all of the key components that we're now going to cover. There's really 5 main elements: the dimensions of the base, the trend, the relative strength, the volume, and as well as the volatility and consistency. When I'm discussing dimensions, the key aspects you want to look at are the length, depth, and shape of the base. So the different shapers will have different criteria specific to them. In the case of the cup and handle, which is what we're looking at here, the general shape is the sideways view of a cup with handle. That's where the name comes from. Essentially, this shape is important because you have a basing structure where the base is correcting, the stock comes up the right side rather strongly, and there's one last correction before we break higher to shake out all of the weak hands. That's what the purpose of the handle is on the right side of that base. Now, in terms of the other dimensions, we're looking at a maximum depth of 35% and a minimum length of 7 weeks. That maximum depth and minimum length of time is really important to isolate the quality patterns from all of the random consolidations that are taking on in the marketplace. So oftentimes there can be bases that are just way too deep that look like a cup and handle, but that depth shows that there was a lack of institutional support. I mean, any stock that breaks down 50 or 60% means that there weren't institutions ready to step in and buy that stock when it was down only 20 or 30%. As well, if the base is only 3 or 4 weeks long, enough time hasn't passed for the equilibrium to reestablish in that basing structure and for that fight between bulls and bears to take place where the bulls eventually win and push the stock price higher. So oftentimes enough time in the market is really critical to identify substantial bases rather than any normal small consolidation. One aspect I want to just bring up is that sometimes the market can enter into a big correction, or even a bear market at 20 or 30%. And if the market is corrected 30%, it's going to be very difficult to find a base that has corrected less than 35%. So in those cases where the market has made a big correction, it's okay to allow a stock to correct more than the maximum of 35%. And I like to use the basis that a stock shouldn't correct more than 2.5 times the market correction. So if, for example, the market corrects 20%, you can sometimes take bases that are 50% in depth. However, most of the time, and when you're not looking at bear markets, you want to really have a maximum depth of 35% for your bases. So once you have all of those different dimensions in place, the next thing you want to pay attention to is really the trend. And there are a couple of ways we can do this. Number one, the moving averages are key here. Here I have the 10-week moving average, which is the equivalent to a 50-day moving average on the weekly chart. And here we have the 40-week moving average, which is the equivalent to the 200-day moving average on the daily chart. And just being above these averages is really key. It really demonstrates that the stock is being accumulated and the market recognizes that the stock is improving. I mean, you're above the average price you've been for the past 50 or 200 days or 10 weeks or 40 weeks. And regardless of fundamentals, you really need the market and the price action to be on your side. That shows you that the institutions are accumulating stock, because if you're below those key averages, something is wrong with the stock. And the majority of these advances, you can see here that throughout this entire 300% gain, for most of the time, you were above that 10-week moving average. So if you're below that average substantially, you're lowering the probability that you have a stock that's being accumulated by institutions. Another key aspect besides being above your averages is that you really want a prior uptrend to your basing structure. The only time this wouldn't apply, again, is if the market's coming out of a big bear market, but usually you really want that prior uptrend because that really shows that institutions have already recognized the story and have already accumulated the stock substantially. You can see here this prior uptrend, the stock had already advanced by 55%, and most people think, wow, that's already a great amount. How much more can the stock go? Well, that was just the opening move of what became a monster run in Booking.com. And don't forget, we're looking for these major moves. So even though you have a prior uptrend, that's just showing that institutions have begun to do their buying. Remember, if the fundamentals are great, they're going to be buying the stock for months and months at a time as they position into this next big major market leader. And the reason you want this prior uptrend is that most of these bases will occur just because of weakness in the market. So in this case here, if it wasn't for this 8.1% S&P 500 correction, I bet you, buying would have continued throughout this time period, and really it was the weight of the market correction that caused this base to form. So that prior uptrend shows that institutions have begun buying, and as soon as this market correction ends, you're likely to really slingshot higher and continue your major advance. Beyond trend, what I really like to focus on is relative strength. Now, relative strength is such a key component, and I really think that is what separates quality bases from non-quality bases. But we're going to take a look at NVIDIA next, where we're really going to dive deeply into relative strength. And once I explain that to you, I would like you to come back to this Booking.com to look for those relative strength aspects in this chart. But for now, let's just move on to volume characteristics. And really what you want to look for is volume spikes on the upside. So you'll see here, this whole move started with this big up week, and you had an immense amount of buying that came into the stock. And that kind of rush of volume into a stock and that kind of major volume spike only happens by institutions. I mean, that's not retail or small investors that are causing that kind of a surge in volume. They just don't have enough money to really drive that kind of volume in the marketplace. So that's really the footprint of an institutional investor. And you'll see all of these stocks that go on these major runs, you'll see multiple buying volume spikes along the way. You'll see here volume spike, and that doesn't take place just prior to the base. You usually see that as the uptrend unfolds as well, as they continually run into the stock to buy more and more as the trend progresses. But in terms of the actual basing structure, there may be some times where you get some rather high volume on the downside. That's normal. There is some selling that takes place. But what's really important is that as the stock shapes the right side of its base, that you start to see these volume spikes come in on the right side. Now, this is really a volume surge, as you can see here. It's not always as pronounced. But what you do want to see is you want to see some volume spikes that are at least as large as the downside spikes on the left side of the base. That shows that buyers are really back into control on the right side of the base. And they're not just buying, somewhat lethargically. They're really rushing in, and they're doing an immense amount of buying. So that momentum is reigniting, and they're starting to step up their buying rather significantly. The last way I like to use volume is really on the breakout. So a lot of these shaper patterns are built around breakout points where we break above a prior high. So you can see in the cup with handle, the buy point takes place above the high of the handle, which is the high price point of this pattern. And the reason you have this handle is that sellers came into the market at this point in time and brought supply into the marketplace. But you really want to know, as prices break past the prior high, that it takes place with a lot of volume. So you know that prior seller is really being fully absorbed by buyers. And once that seller is out of the way, the stock is clear to move substantially higher. And that big volume really confirms that. In fact, if I see a breakout and volume is just average or below average, I'll often just pass on the buy, because typically sellers kind of lurking in the background is going to come right back in and sell into that market. So you really want to see a big volume break of that prior high to confirm that that pattern is breaking out successfully. The last component we're going to cover here is volatility and consistency. And I know some people like to see very wide-ranging bars on stocks. They think that there's more upside because the stock can move really quickly. But what you want to see is consistency. And one way you see that is when you see very low volatility. And one way I like to look at that is really what William O'Neill calls tight weeks. So for example, a tight week is whenever you close within 1.5% of the prior week. So for example, if a stock closed at $100 last week, it would be considered tight if you closed between $98.50 and $101.50. So basically 1.5% in either direction. And that really shows that institutions have been there for 2 or 3 weeks in a row buying at about the same point. And that consistency is really the footprint of an institution. Again, no individual investor has the firepower to really buy a stock consistently over multiple days at the same price. And you see here on the chart that happens multiple times. as the base structure begins, you get 3 weeks here where we close pretty much in the exact same place. And that tight trading and that dry up of volatility and that consistency is really the footprint of an institution. You see that at the bottom of the base where we have 2 weeks tight right here. As well, I know there's an up week in the middle, but this third week here ended up right back in the same place. So whoever was buying at this point in the base stepped right back in to buy again as the stock dipped once again. And that really shows this consistency over a number of weeks. As we push really strongly higher, we see 3 tight weeks once again, showing that there's really that buyer is still present in the marketplace. And even in that handle period, we see 2 weeks tight once again. And so that consistency is just so important to see. And another way you can really identify consistency is buying over a number of weeks. You can see here out of this cup with handle base, you had 5 weeks in a row higher. Now to buy a stock for 5 weeks in a row, week after week, that takes an immense amount of buying power, and that's targeted controlled buying power. That's someone who has a buy program to accumulate a large amount of stock or several funds doing that. And again, that's the footprint of institutions. You see that again here after a quick touch of the 10-week moving average, we have 7 weeks up in a row. To deliver that kind of buying power over a consistent period of time is really the footprint of an institution. And as we mentioned in the principles portion of the course, institutions really drive individual stock moves. So whether your stock is going to be a major success or not is really going to be determined by the institution. So you want to be on board. And when they start buying, they're going to buy for weeks or months at a time. So the shaper pattern should have all of these criteria that really identifies that they're present in the stock and that the stock is being accumulated over time throughout the basing structure. So here we're going to take a deeper dive into relative strength, and I think it's such an important quality of every successful base that I want to spend an entire chart only on this topic. And if you go back and you look at all the major winners, if you look at the first 100 pages of William O'Neill's book, How to Make Money in Stocks, where he shows weekly chart after weekly chart of all these huge winners, you'll really notice that most of these bases form with really strong relative strength. And the way I like to analyze relative strength is simply by comparing 2 points on a chart. So my favorite setup is when I see the S&P 500, which is displayed here with the orange line on the top of the chart. If the S&P 500 makes a lower low, but the stock price makes a higher low, that's showing an immense amount of relative strength. I mean, most stocks really track closely with the market, and the fact that Nvidia here from point A to point B made much higher lows, especially on a percentage basis, whereas the S&P made lower lows, that really shows that there's strong accumulation going on within the stock. So that's one way that I like to identify relative strength. The second way that I identify it, and Nvidia had both of these components to its basing structure, is that a stock that is able to get to new highs out of a base prior to the S&P 500 is also displaying relative strength. So you can see here, Nvidia ran up and took out the highs prior to the basing structure, but the S&P was still quite a bit lower than its highs in early 2016 and late 2015. So Nvidia here was really showing relative strength in 2 different ways, by not making lower lows and racing back to highs before the S&P 500 did. And you'll see throughout the entire advance, Nvidia was really screaming to the market and to the world that it was being accumulated. You can see between point C and point D, the market made lower lows, but Nvidia made substantially higher lows. As well, it got back to new highs much quicker than the S&P 500. The case was exactly the same here between point E and point F. The market made lower lows, whereas Nvidia made substantially higher lows. And this is really my favorite setup. I would even use this when I was day trading. But when you tie that in with the shaper patterns and these weekly charts, and you can see this relative strength dynamic taking hold, it is very powerful. And I really prefer this to using a composite number or using a relative strength line, because this really forces you to look at how the stock is reacting compared to the index itself. And to see an index breaking down and a stock holding up is the best signal in the world that people are putting their money where their mouth is and they're buying that stock despite market weakness. And the ability to get to new highs prior to the market really shows that as soon as the weight of that market is coming off of the stock, people are going to be racing to buy that stock, and it just flies to new highs before the market. So that's really a key component, and that really underpins every quality basing structure. And I'm going to point this out throughout the entire course every time I see this relative strength. And I really recommend on any chart that you're looking at to draw these lines in between 2 points. If you can see the market making lower lows and this stock making higher lows over that same period, highlight that on your chart, and that's really going to show you that you have a quality pattern developing. We're going to go into great detail about all the characteristics of all these different shaper patterns. But at first, I think it's best that we have a good visual overview of all the different patterns, their shapes, and their basic dimensions. I want you to become accustomed to all of these different patterns. But if ever you're in doubt, check the criteria and make sure that all the dimensions are proper and all the other qualitative factors that we covered, such as the volume, volatility, consistency, and relative strength are there. Unless stated otherwise, all of the exit points for these purchases at these breakout points are going to be below the low of the day of the breakout. The aim is to have a tight risk on these positions. Even though we're using weekly charts to identify these positions, the breakout day is a significant day. Usually it should be accompanied by very high volume, and if that day fails, typically you need to exit that position. But because we have all the tactical patterns, even if it is a short-term shakeout and you're stopped out of your position, we'll have multiple ways to re-enter. That's the strength of having all of our tactical patterns to work along with these shaper patterns. But if you do use these shaper patterns as an entry point, which I do, you're going to want to exit if that breakout day fails, because oftentimes failed moves lead to fast moves against you. So we're going to go over again the cup with handle very quickly. These next 6 charts can be some charts you can keep on hand so you can recognize these patterns as well as the minimum stats that you need to pay attention to. Essentially, this is the shape of the cup with handle as you can see here. The buy point is indicated above the high of the handle. And the key stats to look for is that you want to have a minimum length of 7 weeks, and the maximum depth can be 35% or 2.5 times the S&P 500's correction. Again, if you're coming out of a bear market and the market falls 30%, it's going to be normal that a lot of these stock bases will be deeper than 35%. However, if the S&P has gone under a minimal correction, you really want the maximum depth to be 35%. We want to start counting the first week of the base as that first down week here, and the last week being the week prior to the breakout. So you can see this is a 9-week base here on CF Industries back in 2007. The first pattern that's new here is the double bottom base. As you can see, the general shape of this pattern has 2 bottoms to it, and the second bottom really wants to undercut the first bottom, causing the shakeout within the base. We're going to go into detail as to why that's important later on when we dive into this pattern itself. But again, the minimum length that you're looking for is 7 weeks. That's consistent with a lot of the different patterns we're going to look at. And the maximum depth is 35%, or again, 2.5 times the S&P 500's correction. Here we have a nice 25-week double bottom base on Facebook back in 2013 prior to its major advance. This pattern is the Shakeout plus 10%. I call this a sister pattern to the double bottom because the concept is really pretty much the same, only you have a different buy point as a result of the way the base forms. Essentially, you have a first low at point A, similar to the double bottom, but what's key is that the second low doesn't break the first low by more than 10%. And if that's the situation, when this rebounds higher by more than 10% above point A, that becomes your buy point. We're going to dive into the details of this pattern later. I just want to make you aware that this is also a minimum length of 7 weeks for this pattern to be qualified as a proper shakeout plus 10%, and the maximum depth again should be 35%. It's just really important that the stock does not trade by more than 10% below point A. Here we have an 11-week shakeout plus 10% base in OLED back in 2017, which preceded a great move higher in a very short period of time. Here we're looking at Lending Tree in 2017, and the flat base is the shortest of all the patterns. The minimum length is only 5 weeks, but here we want only a maximum depth of 15%. As you can see here, it's a very shallow base, and this is really a pause within a general uptrend. This rarely is the first base of a trend. It is really a pause as the trend has already developed somewhat. The breakout is right above the highs of the entire basing structure, and really what's important here is that the stock consolidates sideways in a relatively calm manner for at least 5 weeks, and it's a very shallow base. This is the high tight flag base. It is a very unique base that doesn't show up often, but when it does, it can deliver rather substantial upside results. We're looking at Tesla here back in 2013 when the stock was just starting to get going. Essentially, what we're looking for is that you want to see a prior uptrend to the base of at least 80% within less than 8 weeks. So you can see here, Tesla really skyrocketed higher, and you definitely went up by at least 80% in that period of time. And then what we're looking for is a 2 to 5 week basing structure where after that very, very strong advance, the stock just goes sideways in a tight manner, and the depth is a maximum of 25%. So you want the stock to correct, but not more than 25%. Ideally, you see some tightness in the base. You can see here that the weekly closes are relatively close to each other. So despite this major advance, the stock is really still being accumulated. That's what we're looking for. We're looking for a stock that is under such big buying pressure that despite a major advance, it's just taking a small pause before it rockets higher. Similar to a lot of the other patterns, the buy point takes place as we break above the left side high of the flag, and that's your buy point. So the key aspects of this base is that you're really paying attention to the length and the size of the prior uptrend, as well as a maximum depth of only 25% and a basing structure of a minimum of 2 and a maximum of about 5 weeks for it to be a proper high tight flag. The last shaper pattern that I want to cover is the shaper coil. This is a pattern that I've identified over the years that's not covered in William O'Neill's book, How to Make Money in Stocks. A lot of the key stats are the same. I'm looking for a minimum of 7 weeks and a maximum depth of 35%. But in terms of the shape of the pattern, you're looking for a triangle shape, really essentially a coil where the volatility is contracting throughout the entire pattern. And a key component is that you want at least a 3-touch trend line on the upper side of the pattern. And 3 touch points is very important because it adds validity to that trend line. Essentially, a trend line can be drawn anywhere with 2 touch points. And the fact that this line was touched not once, twice, but 3 times means that this trend line is really a line of resistance that's declining on the stock price. And when that declining line of resistance is broken with good volume, that means the coil is expanding and price should really accelerate to the upside. So I use this as a pattern, and it's one I like to look for, and it gives a great buy point as you break that upper trend line. Now that we've covered all of the different patterns rather quickly, you can keep these charts with you as a quick example of what all the different shapes should look like and the key criteria behind them. And we're now going to move into each shaper pattern in detail. So we can look at a number of examples so you can really get your eye trained to noticing them and how these different patterns develop in all of these different stock moves. First up, we're going to take a look again at the cup with handle.